Hello traders and welcome back to another episode of Trade Like Assad. Flip patterns remain one of the most overlooked setups in smart money concepts. Still, they deliver some of the top win rates of any SMC model. And when you align them with higher time frame context, they become far more effective than standard change of character setups. If you understand flips correctly, you can spot major reversals and trend shifts before the market makes its move. That's why today I'm going to show you a complete trading model built around flip zones. How they form, how to identify them on any chart, and how to turn them into clean A+ trading opportunities step by step. This strategy is simple, powerful, and one of the biggest edges you can add to your SMC toolbox. We always appreciate your support, so make sure to give this video a thumbs up. And if you're new here, don't forget to subscribe. See you right after intro. Welcome back traders. So, let's begin. This high-impact trading setup blends higher time frame flip patterns with refined entry models such as breaker blocks or mitigation blocks, creating a highly efficient trading model capable of producing A+ trades on any chart and pair. In a bullish scenario, this setup appears when price flips the most recent demand zone immediately after reacting to a higher time frame area of interest. Price then revisits the newly formed flip zone, which now functions as a supply area. And from there it often reverses aggressively, driving completely against the existing trend and validating a potential change in market direction. Likewise, in a bearish scenario, this setup forms when price flips the latest supply zone immediately after being rejected from a higher time frame area of interest. Price then retraces into the flip zone, indicating a possible transition from bullish strength to bearish pressure. Of course, it's not as straightforward as it sounds. Several key conditions must be satisfied before this setup becomes valid. So, let's make this perfectly clear with a price chart example. So, in a bullish market profile, imagine price originates from a higher time frame demand. That tells us demand zones are firmly in control. The first step is to determine market direction by marking the breakouts and the demand zones linked to each impulse leg. Because every time price breaks a high to the upside, it creates an unmitigated demand zone at the origin of that impulse move. Now, after applying the price action toolkit and enabling the boss boxes in the market structure section, you can clearly see that price is in an uptrend. It has already formed multiple breakup structures to the upside, and these are the demand zones connected to each of those impulses. What we want to see next is price tapping into a higher time frame point of interest. In this case, an unmitigated supply zone or an unfilled fair value gap and showing rejection. Once that occurs, price shifts direction and retraces until it reaches the most recent demand zone on the current time frame. It then tests that zone, shows a small reaction to the upside, and immediately breaks through it with a strong bearish displacement leg. This sequence confirms that supply is regaining control of the market, signaling an upcoming shift in market direction. Now, we have a flip zone positioned in the premium area, giving us an ideal selling opportunity if price retraces into it. This may seem a little complex at first, but don't rush it. Relax. We're going to break everything down into actionable, easy to follow steps with all the conditions and rules required before the setup becomes valid. But before diving into those details, let's quickly recap what flip zones are and how to correctly identify them. A flip is focused on a minor reaction of price at a key demand or supply zone followed by an immediate breakout. It's a strong reversal pattern that signals an upcoming shift in market sentiment and direction. Flip entries are one of the best ways to jump into a setup early while the market plunges or accelerates. In a bearish scenario, the core psychology behind a flip is straightforward. Price is in an uptrend, demand zones are in control, and we naturally expect price to continue pushing higher. But suddenly, the entire narrative changes. The most recent demand fails to generate sufficient bullish momentum to break new highs. It weakens, loses relevance, and eventually gets broken. This zone breakout tells us supply has regained control, and from this point forward, we should be looking for selling opportunities. So, the last up-close candle or the cluster of up-close candles at the origin of the bearish flip move becomes the flip zone. In simple terms, those bullish candles within the reaction phase represent a key area where we should look for short opportunities if price pulls back. Similarly, A bullish flip zone forms when price shows a minor reaction to the latest supply and then immediately breaks above it. So, the last down close candle or series of down close candles at the origin of the bullish flip leg defines the flip zone. Now, you might ask, what's the difference between a change of character and a flip? Flips are similar to CHOCHs because both are reversal patterns. But here's the key distinction. Every flip is a CHOCH, but not every CHOCH is a flip. Price typically reverses much faster when a flip forms, which means flip patterns provide a stronger edge than standard change of character setups. They're also more mechanical, rule-based, and easier to trade because they offer a clear entry point while signaling a potential shift in market direction. But remember, not every flip is valid or tradable. For a flip to be considered valid, price must first mitigate and reject a higher time frame key zone. This rejection shifts market sentiment and sets the stage for a true directional flip. If price does not mitigate a supply or demand zone and instead forms a flip pattern in the middle of nowhere, it's most likely just an inducement, a liquidity grab, or a routine retracement, not a genuine shift in market direction. And patterns like that must not be treated as valid flips. Additionally, flip patterns become even more powerful when price leaves a clear inefficiency behind during the flip. In that case, price is far more likely to return and mitigate the flip zone. To apply this strategy correctly, you'll need to work with 3 time frames. A higher time frame to identify unmitigated areas of interest such as supply or demand zones. A main time frame to evaluate overall market conditions and to identify flip patterns and flip zones. And an entry time frame to zoom in and look for reversals and confirmation signals. This is where you'll actually place your entry. These are my recommended combinations that you can use. Of course, you can work with other time frames as well, but make sure to backtest them first before trading them live. Now, let's go step by step and see exactly how this plays out on the chart. In a bullish scenario, the very first step is analyzing market structure on the higher time frame and identifying the nearest unmitigated demand area that price is likely to reach. Once price taps into that higher time frame area of interest and shows rejection, the setup begins. Next, zoom into the main time frame and wait for price to retrace upward to test the most recent supply area on the main time frame. After a small reaction to the downside, price should immediately break above it. In other words, flip the latest supply. From there, trace back to the origin of the bullish expansion move, the reaction phase that caused the break. That origin point becomes the flip zone. This flip tells us the temporary bearish retracement is ending and bullish momentum is returning. At this stage, we expect price to realign with the higher time frame trend. The next step is to mark the flip zone on the main time frame. Then wait for price to return to that zone. Once price taps back into the flip zone, zoom into a lower time frame and closely watch for reversal signals such as VSR patterns or a clear shift in market structure. At this stage, we have 2 different entry approaches for opening a long position. Each has its own strengths: the mitigation block and the breaker block. Traders, it's finally here. The SMC Trading Mastery course, built to take you from confused to confident. With a complete trading system that actually works. This program breaks down smart money concepts, high probability setups, and real risk management, step by step. And right now, you can grab the entire course for just $500, plus an exclusive 61% discount for early buyers. No tricks, no fluff, just pure trading education. And here's the crazy part: we're giving away 5 $100,000 funded accounts to course members. Don't wait, click the link, secure your spot, and start leveling up your trading today. In the first entry method, after price taps into the main time frame flip zone, if a mitigation block forms on the lower time frame, it presents a strong opportunity to go long. For a bullish mitigation block to form, price must first create a swing low, then a swing high, followed by a higher low. After that, we need to see a market structure shift with a bullish displacement leg that closes above that swing high. In this case, your bullish mitigation block will be the up-close candle or series of up-close candles formed between that initial low and the first high. To execute the long trade, place your limit order at the highest point of that mitigation block and wait for price to activate it. For a take profit, you can target the nearest liquidity pool on the current time frame or aim for higher time frame key levels if you want a larger move. Now note that the breaker block differs from a mitigation block because with a breaker block we look for a lower low, not a higher low. So in the second entry method, we wait for a bullish breaker block to form inside the main time frame flip zone. For a valid breaker block, price must first create a swing low, then a swing high, followed by a lower low. After that, we need an immediate expansion move in the opposite direction that creates a market structure shift. In this scenario, the up-close candle or cluster of up-close candles between the first swing low and the swing high will define your breaker block area. That's the zone you use to open a long position. And of course, the same concepts apply to bearish entry methods, only in reverse. Now that we've covered all the rules, details, and everything you need to apply this strategy properly, let's walk through a real chart example to solidify what we've learned so far. Here we have the Euro-Dollar 4-hour chart on the screen. As you can see, price is in a strong downtrend and sellers are clearly in control. The most recent bearish boss is located right here at the origin of the move that formed this boss. We can see an unmitigated supply zone. So, I'm going to mark this up-close candle as my supply area. This gives us a fresh, clean supply zone. And this is exactly where we want to keep our focus because it's an ideal area to look for short opportunities if price pulls back into it. The next step is simply to switch to our main time frame, which in this case is the 15-minute chart, to get a clearer view of the price action and wait for price to tap into this 4-hour unmitigated supply. Now, let's unfold the chart and see what happens next. On the 15-minute chart, you can see that after tapping into the higher time frame supply, price reversed and formed a clear VSR, a classic V-shaped recovery pattern. If you mark out the bullish boss levels, you'll notice that price created several consecutive demand zones on its move into the 4-hour supply area. Also, after tapping the higher time frame supply, price retraced downward and after a small reaction flipped the most recent demand by breaking and closing below it. At this point, price is expected to realign with the higher time frame direction, which is bearish. So now we have a valid flip zone on the 15-minute chart represented by this up-close candle. With these confirmations in place, we can expect price to return to the flip zone before continuing its move towards sell-side liquidity. On the 1-minute time frame, you can see that price pushed upward and after tapping the flip zone, reversed sharply and formed both a market structure shift and a VSR. At the same time, it created a breaker block represented by these 3 down close candles. Notice the sequence here. Price first formed a swing high, then a swing low, followed by a higher high. But immediately after, it reversed direction and closed below those down close candles. This confirms the breaker block and gives us another strong confluence for a short entry. With these confirmations in place, we can expect price to pull back to the breaker block before continuing downward towards sell-side liquidity. Next, I'm placing my entry at the lowest point of the breaker block with my stop loss just a few pips above the higher high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now, let's see if the trade plays out successfully. As you can see, price pushed higher, activated the sell limit order, then moved lower, and eventually hit the take profit. Now, let's move on to the next real chart example. Here we have the pound-yen 1-hour chart on the screen. As you can see, price was in a strong uptrend until everything changed when price broke and closed below the lowest point of the most recent bullish boss, forming a clear bearish change of character. From that moment forward, price continued to drive lower. So from here, our bias shifts and we're now focused on identifying short opportunities. If you look closely, you'll notice an unmitigated 1-hour supply area sitting right above the current price. A perfect zone to look for selling opportunities if price retraces back into it. The next step is simply to wait for price to tap into this 1-hour unmitigated supply. Now, let's play out the chart and see what happens next. As you can see, price pushed higher and tapped directly into the higher time frame supply zone. Now, everything lines up perfectly, so I'm going to zoom into the 5-minute time frame for a clearer view of the price action. And here on the 5-minute chart, you can see that after tapping into the higher time frame supply area, price reversed and after reacting to the most recent 5-minute demand area, immediately flipped it with inefficiency. I'm going to highlight these up-close candles as my bearish flip zone. This gives us a fresh, clean supply area. Next, we zoom into our entry time frame, the 1-minute chart, and wait for price to return to the flip zone. Now, on the 1-minute chart, you can see price pushed upward and after tapping the 5-minute flip zone, reversed and formed a clear market structure shift along with a mitigation block represented by these 3 up-close candles. Notice the sequence. We have a swing high, then a swing low, followed by a lower high, and immediately after, a reversal that closes below the swing low. With this behavior, we can anticipate that price will return to the mitigation block zone before continuing its move towards sell-side liquidity. Next, I'm setting my entry at the lowest point of the mitigation block with my stop loss just a couple of pips above the upper swing high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now, let's play out the trade and see how it unfolds. As you can see, the order was activated. After a brief drawdown, price reversed, pushed lower, and eventually hit the take profit exactly as expected. That's it, traders. Thanks for watching. Most people quit right before the breakthrough. Don't be one of them. If this video gave you strength, hit the like button, and if you're new here, subscribe and turn on the notification bell so you stay connected to your growth. Listen, the progress you can't see is still progress. The work you're doing in silence is building a future that will speak for you. You're closer than you think. Hold your ground, stay disciplined, and keep moving forward. I'll catch you in the next video.